How to make sense of this crazy stock market? Since March of this year, Trump's trade wars has triggered a rapid sell down across the world's stock markets. So what do? But first, a disclaimer. The information provided is not financial advice. This information is purely from my own due diligence and an expression of my thoughts, my opinions, and based on my personal experiences and the way I transact. As a recap, in the previous videos, I spoke about not being able to avoid the worst and the best days, because the worst days almost always happens first and the best days closely behind. You cannot have it's like the rainbow and the rain. You cannot have rainbows without first having a rain. If you can see here, most of the worst days in the last 20 years, for example, September 29, 2008, October 9th, those sell downs were 8.8% and 7.6% within a day. And it is followed by 11.6% bounce on October 13th, 2008. So those were the historical crash and the incredible rebounds during the global financial crisis. They all clumped together. October 15, 2008, down 9.04%. And then October 28th, just about 2 weeks away, up 10.8%. Then November 13th, about 2 weeks later, up 6.9%. November 19th, down 6.1%. November 20th, down 6.7%. And 21st, up 6.3%. November 24th to 8, up 6.5%. And December 2008, 8.9%. And then about 3 months later, that was close to the bottom of the market, 2009, March 10th, when Obama took over and they had the first quantitative easing in the US, up 6.4% in the day. March 23rd, 2009, up 7% in a day. Then in 2011, we had the European crisis, August the 9th, down 6.7%. Then we had the COVID, 2020, March the 9th, down 7.6%. March the 12th, 2020, down 9.5%. March 13th, up 9.3%. March 16, 2020, down 12%. And then closely followed March 24th, 2020, up 9.4%. April the 6th, 2020, up 7%. So you see that, again, they are so close, like Siamese twins. It's impossible to avoid it. The only way is not invest at all and then wait for a crash and then go in. But then not investing at all is a problem, because 75% of the time the S&P 500 is up and the average return is 10% a year. You're missing a lot. The only other way, of course, is when the S&P 500 is overstretched. You start to keep 10 to 20% in cash and stay out of the market and holding them as ammunition while waiting for a crash. And upon a crash, you go in and buy. Both have their drawdowns. Now, holding 10% cash, high can get higher, overstretched can get even more overstretched. Imagine the returns were 10%. By holding 10% cash, you are only getting 9% return on average. And if you are holding on to 20% cash, you're getting 8% return per year, just waiting for that 1 quarter occurrence, that 25% of the time where it's in a bear market. So there are pros and cons. So the best way is to just stay invested. And again, in the previous video, I recap again the consequences of missing the best days, right? There are a lot of YouTubers, influencers, economists that tell you that, hey, you need to jump in and jump out. Unless you are best buddies with Trump and you sleep on the same bed as him, you wouldn't know. And by jumping in and out, just by missing the 10 best trading days, which is just 0.2% of the 20 years, your returns fall by half. Just missing 1.2% of the 20 years, the returns fall to negative 5% per year. The message is to stay in the market at all times. It is a roller coaster ride, and you got to stay buckled to your seat until the ride ends. And this is a poorly drawn roller coaster drawing. it goes higher and higher, and you start off with $100,000. In 10 years' time, you get $10 million. In 10 years' time. So investing in stocks is volatile. That's because it's easy to buy and sell. That's the characteristics of stocks. But it keeps going higher and higher. It zigs and it zags. It's unlike property, which is not easy to transact. Owners think for a long time. If you have a property and it's downturn, and if it's your home, you think twice, 3 times, and take a long time. You hold on for dear life for your property because it is very troublesome to move. And to put it out of the market, it could take 6 months to a year to sell, sometimes even 3 years. So stocks are different. You wake up at the wrong side of the bed or the right side, you start buying. If you feel happy, you buy. A lot of people do that. If you feel sad, you start to sell. And if you see the news, oh my goodness, you start to sell. Okay, so volatility of stocks also presents opportunities to buy good companies at 30, 50 to sometimes 80% discount. It also allows you to sell at 50, 100, 200% premium to fair values. This is unlike property. Very rare to get properties at 30% discount even. I would say that you'll be lucky if you get 10% discount. However, here's the thing. A lot of banks, especially banks that serve high net worth clients like private banks, like to advocate leverage or borrowing to buy more stocks. It's because they can earn interest and fee income, which is recurring. But leverage is like quicksand waiting at each downturn. So imagine you have this roller coaster. Every time it goes down, there's a pool of quicksand. You get stuck, you lose momentum, and then you sell your stocks at the worst possible time. Each time you get stuck, it gets harder to recover. So instead of losing 20% in a correction, you could lose 40 or even 80% with leverage, and it will take you 150 to 400% to recover. And every time you get into the mud, you get out, it gets heavier and gets slower because you lose, you're forced to sell stocks. And in a 10 years journey, instead of getting 100, from turning 100,000 to 10 million in the previous video, you only end up with 200,000. So that's what leverage does to you. Very few people can cope with leverage. Property is a bit different. To get the return is a leverage product because the volatility is much less. It doesn't go through enough. There's a quicksand. If you fail to service your loan, your mortgage, monthly mortgage, you do get margin call. Or in very rare circumstance, if your property gets marked down by 25% and your loan to value is 75%, you do get asked to top up. But it is not a lot. You have to top up some cash and then you're fine. Okay, but it is not a very common occurrence. So because of the lack of volatility caused by very little mark to market, because there's very few transactions you notice during a recession, it tends to be a suitable asset class for leverage. Will the trade wars end? Well, Trump later or recently exempted smartphones, laptops, televisions, semiconductors, and other electronics from the tariff. This is a sign that Trump knows it's a zero-sum game and will lead to future wars. Actually, free trade between countries stops wars. The European Union was formed after World War II to stop another war between the European countries. And we all knew what happened in 1930s, where the tariffs set up by the US actually went to the highest level, just like now. And it led to Japan's aggression because they couldn't get the materials that they want, and it also led to Germany starting the World War II. Also, this correction is one of the 5th fastest for the S&P 500 in history. Whenever stocks fall this fast, they will recover very quickly. To make sense of this volatility, we must remember that the stock market in the short term is a voting machine subject to the sentiments of the investors. In the long term, it is a weighing machine where stock price will move towards their fair value. So this is the top 20 stocks or thereabouts in terms of quality. I just did a simple filtering using my own factors and my formula. So during this market turmoil, we should all look at the stocks we own as our businesses. So for example, for $1 million invested, you will have generated $32,000 of free cash flow based on $1 million invested. So if that That results in a yield of 3.64%. But in the last 5 years, these companies grew their free cash flow at 39% per year. Well, that's incredible growth, right? So earnings per share growth for the next 5 years, I'm projecting conservatively because of their white moat, 16.9% per year, including dividend yield of 0.64% on average. The expected return for the next 5 years is 20.9% per year. Think of the free cash flow that will grow at that speed. That $32,000 of free cash flow generated, think of yourself as a business owner, it will grow to $70,328 in year 5. And in year 10, it will be $153,334. That's 15%. The cash flow in 10 years' time generates 15% of your initial invested capital. And that's the power of compounding. So as a business owner, even as you sleep every day, you're going to get this passive cash flow that is going to be yours. And the share price will eventually, over 3 to 5 years, lead towards that. And research has always shown that share price follows earnings per share growth. It follows free cash flow growth. And if it grows at 20%, eventually the share price will also grow at 20%. So, ladies and gentlemen, I hope you find this comforting to think long-term like a business owner, because the shares that you own, you're actually part of the business as an investor of the business. And if you find this video and other videos useful, do like and subscribe so that you'll be informed of the next video. And I'll see you for the next one.